BP has delivered the kind of quarterly number that normally ends the argument. Underlying replacement cost profit reached $5.73 billion, more than double the $2.35 billion recorded a year earlier, and the company's highest quarterly profit since 2022. But the more important story is that BP is making this money while dismantling parts of the business that created its old identity. The Middle East conflict pushed Brent crude to an average of $103.85 a barrel, against $67.88 a year earlier. That lifted BP's hydrocarbon realizations. Refining margins also surged, while trading benefited from volatile markets. BP's Customers and Products division became the main earnings driver, with profit before interest and tax rising to $4.95 billion from $1.53 billion. That is the windfall. Operating cash flow rose 73% to $10.86 billion. Net debt fell to $22.25 billion, and BP raised its dividend by 4%. For a holder, this is tangible. More cash arriving now, a stronger balance sheet, and evidence that the company can still generate substantial returns when energy markets turn sharply in its favor. Yet the quarter also exposes the limit of that interpretation. Upstream production fell 4.3%. Oil production and operations output dropped 5.4%, and gas prices were weaker. BP made more money despite producing less because prices, refining margins, and trading conditions did the heavy lifting. The result, therefore, says much about the environment BP operated in, and less about what the business would earn in a normal one. That matters because BP's recent reading had already shifted from growth to repair. Its new chief executive, Meg O'Neill, has said the group became too complicated, too costly, and too distracted. The company has put its North Sea business up for sale after 6 decades of production, is selling its U.S. biogas business Archaea, and has been exiting other assets. The stated test is value, not sentiment or history. Keep the assets capable of delivering competitive returns, and sell the rest. Seen that way, today's profit is not proof that BP's previous strategy was right. It is funding the attempt to build a narrower one. The money from a high oil price gives management room to reduce debt, pay shareholders, and redirect capital. But it also makes the test harder, because a windfall can disguise weak underlying economics. BP itself says it has not consistently delivered, has written off too much value, and has not built a cost base resilient enough for a low-price environment. There is a credible alternative explanation for the profit surge. This was simply a sector-wide commodity shock. Shell also reported a sharp rise in profits, and BP's own figures show how dependent the quarter was on refining margins, hydrocarbon prices, and trading. Those gains can reverse. BP's upstream production guidance for the third quarter is 2.1 to 2.25 million barrels of oil equivalent a day, while product throughput is expected to be 1.36 to 1.41 million barrels a day. The next results will show whether the reset is improving the quality of earnings or whether the business is merely smaller and still exposed to the same cycle. For a holder, the sensible conclusion is not to treat $5.7 billion as a new normal. It is to judge whether the cash is being converted into lower financial risk and better returns across weaker markets. For someone watching the shares, the question is whether the disposals create focus without removing too much future production and cash generation. The next evidence is unusually concrete. BP expects 2026 capital expenditure of $13.5 billion to $14 billion and divestment proceeds of $8 billion to $9 billion, including roughly $6 billion from the planned Castrol transaction. Investors can watch whether those proceeds arrive, whether debt continues to fall, and whether operating performance holds up when refining margins and oil prices are less generous. What remains unknown is the price and timing of the North Sea and Archaea sales, and whether BP's remaining assets can produce competitive returns through a full commodity cycle. Until that is visible, BP is both a war windfall beneficiary and a restructuring project. The profit surge is real. The reset is still an unproven promise.